Welcome and thank you for joining us in New York. Very excited about this session. We have with us Paul Lountzis, President of Lountzis Asset Management. Paul, it's a pleasure to have you again on the program. Welcome.
Thank you for having me. It's my pleasure.
Paul, the topic for today is Berkshire Hathaway. We're going to talk about your views on Mr. Buffett, and you've been following Berkshire for a long time. You have a lot of experience in the business, starting out at Royce, then working with Bill Ruane at Ruane, Cunniff and Goldfarb. Tell us a bit about what's foremost on your mind today as a Berkshire investor, and I think Berkshire is one of your largest positions. Tell us a bit about what's on your mind today.
Well, I'm quite excited. The annual meeting's in a couple weeks, so that's kind of an annual rejuvenation visit to get more inspired listening to Mr. Buffett and Mr. Munger, which I've enjoyed doing for a couple of decades now. With regard to Berkshire, it's our largest holding. It varies in size within our portfolios, anywhere from 10% to as much as 30%. Across the board, it's probably around 15 or 16% of most of our assets, most of our client assets, client portfolios. And when I think about Berkshire, I think Berkshire, as I've stated before, is safer than a treasury bill with a lot more upside. It's an outstanding company. It's a great, great collection of businesses. It has a Rock of Gibraltar balance sheet. And what's really interesting is Mr. Buffett and Mr. Munger have really created an extraordinary enterprise that, even though they are both critical, particularly Mr. Buffett, I think it will continue to flourish in the future. And I think they both feel it'll actually do even better down the road. I don't know if I would say that, because Mr. Buffett is simply irreplaceable. But he does have a great group of people there, whether it's Todd or Ted on the investment side, Ajit continuing to run the reinsurance, and several top-notch CEOs, Matt Rose at Burlington Northern, Greg Abel at Mid-American, the Wertheimer family at ISCAR. I mean, you could go on and on and on. So I think Berkshire is beautifully positioned going forward. They've always been incredibly open and honest about what they see going forward. Clearly, the anchor of size is a challenge. It's not going to compound at 20% plus as it did for so many years. But I do think Berkshire's opportunities will continue to grow. And I think the evolution of Berkshire from buying the textile mills in 1965, then the insurance company National Indemnity in 1967, then with Mr. Munger's influence, finding and focusing on better businesses, See's Candy in 1972, the Washington Post, a portion of the Washington Post and Geico, the public companies, which they did then for a long time. The value of Berkshire was primarily the public companies in the late 70s and early 80s. It has evolved today as Mr. Buffett has evolved. And it's been an incredible or an extraordinary evolution. And today, the private companies, the entirely wholly owned businesses, are really the driving force behind Berkshire. While the public securities, I think four stocks, Coca-Cola, IBM, which just got hit down to $190, I think it was down 8% because of an earnings miss, but IBM, Coca-Cola, American Express, Wells Fargo. I think, though, and there's Procter & Gamble and a couple others, but I think those 4 or 5 holdings account for the preponderance of the equity portfolio, and that's important. But I think the future of Berkshire really lies in the ability of Berkshire to continue to buy entire businesses, preferably private companies around the world, and secondarily public companies. I also think that the opportunity to do these one-off types of deals, which really came about, I mean, he's been doing that for a long time, but particularly during the financial crisis with GE and several other companies, Goldman Sachs. I think that is another mechanism where Berkshire can continue to make outstanding investments. And I would also say, while Mr. Buffett is probably, I think it's almost unarguable, the greatest investor who's ever lived. One of the advantages he does have is that quasi-permanent capital. The ability to utilize that float and remain ever patient until the right opportunity comes around is simply not something that's available to most investors. Most endowments and others, they've already made the asset allocation decision, and then when they give you the money, whatever the amount, they want it invested right away. And that makes it very, very difficult unless it's March of '09 or some other time.
And there are a lot of points here to discuss further. The importance of negotiated deals as well with Berkshire. So look forward to delving into some of these topics, also some of the things that Warren Buffett mentions in the letter in greater detail.
I look forward to it.